Let's move on to companies where you spend a little bit more time there on the tax side on financial planning. But let's talk about Johnson & Johnson. That's a major drug manufacturer. I'm sure you've heard of them. Not much short on the float there. It's a 0.7%, 74% institutional owned. They do have a PE ratio, not too bad, 17.5 versus 25.2. Price of sales, 4.3 versus 4.1. Price of book value, 4.8. That's better than the industry at 5.6. And price of cash flow, okay, 15.4 versus 15.1. PEG ratio, 3.5 versus 4.2. That's good, but not a great PEG ratio. They have grown their earnings by 36% year over year, but the industry was up 35.4%. Sales did increase by 3.2%. The industry was up 11.3%. The 5-year earnings per share growth estimate from the analysts, 4.3, not as good as the industry at 11.3. They've been known for paying dividends for years. The current dividend yield is 3.3%. They use 55% of their earnings to pay that out. And look at the balance sheet. Quick ratio, 1.3, same as the industry. Debt to equity, very good, 0.7. The industry is a 6. They do have a lot of intangible assets, unfortunately, 42% versus 37%. Net profit margin for Johnson & Johnson, very good, 24.4 versus 16.2. Return on equity, also very good, 27.9 versus 32.1. Wow, I love this number. Free cash flow for Johnson & Johnson, $18.5 billion, about double the industry at $9.8 billion. So we love free cash flow because you can do a lot of things with it. You can buy back stock, you can buy companies, you can pay dividends. Free cash flow, very important when it comes to investing. Chase, what do you got?
Yeah, I was kind of looking at this, and frankly, I was surprised. We haven't looked at Johnson & Johnson in a while, so right.
I don't know if we ever have.
I don't know on the show. I personally, I'll just look at stocks sometimes for fun.
Yeah.
Johnson & Johnson is one that I'm like, we'll look at it today.
It always seems too pricey.
It always does seem too pricey, right. And that's why I'm so surprised, because the current price here for JNJ is now $156.90. The 52-week range is $140.68, and the high here is $169.99. Over the last 5 years, this stock has pretty much done nothing. I mean, you've collected a decent dividend. We'll call it around 3%. I'm not sure how much they've increased during that time period. So, maybe it is a little bit less than that if they've increased substantially. But the 5-year return now is just 8%. So, I mean, it's kind of been, I'm going to call it dead money over the last 5 years. Going forward, the company now, not quite a buy, but we do have a target sell price above the current level. We got to December 2026. I see estimated earnings per share of $11.13. Gives you a target sell of $184.76. It trades around 14 times those future earnings. So it'd be in the hold category for us. But I remember for years it's always like, it's too expensive. And now finally it's below the target sell price.
Yeah, and that's kind of surprising. That's why we don't like to buy companies that are expensive. Again, I think you said over the last 5 years, up 26%, which is not terrible. But
that's with dividends, 26%.
With dividends, yeah, 26%.
The price return's 8%.
8%, there we go. So even with dividends, up 26%, which better than losing money, but still is not as good as it could be because it's always been very pricey. I think there's something else going on with Johnson & Johnson. And they've always had, lawsuits and everything else. There's something else I think you have on Johnson & Johnson, don't you?
This is where I'd be careful, even with Johnson & Johnson trading under our target sell price. I'd want it to be more inexpensive because we're going to have to see what happens with tariffs. I mean, President Trump has now talked about a potential tariff of up to 200%. Now, I think that is him being a little bit over the top. I don't think it's actually going to come out as 200%. And he said that these companies have a year and a half to kind of work on deals to actually bring manufacturing back to the United States. I don't know what J&J's manufacturing print looks like, what their imports look like, but if they do bring a lot of products back to the U.S. from other countries, whether it's 200%, 50%, whatever it might be, that could be problematic for their expenses going forward, and that could have a huge dent on earnings. So trading at 14 times with a large potential risk to earnings, I'd want to see a little bit more of a cushion, I'd say, before stepping into Johnson & Johnson.
And I know it wasn't Johnson & Johnson. It was another drug company, but I was surprised on how much of the drugs, it's a U.S. company, that are manufactured overseas that they bring back over here. And that's what President Trump is saying. Is like, if you're going to do that, we're going to put a tariff on them. If you're going to make drugs, you got to make them here in the U.S. So that could change things. So this could be a boom for the economy. But the problem I look at is like, we're going to have to use a lot of robotics, AI, legal immigration, because we just don't have the people. And again, to build a factory is not done in 2 months. I mean, it's going to take a few years.
And right or wrong, the truth of the matter is, if you bring that manufacturing back to the U.S., your expenses are going to be higher than they are likely in other countries. So where we are today versus a higher tariff or higher expenses in manufacturing here in the U.S., it's going to drive, I believe, higher expenses in these businesses.
And I think it depends on how much automation they can pull out of that, because this is going to be star of the eight, all these new factories. You do have the distribution costs. You do have labor in other countries.
They're not going to be able to do that in a year and a half, though.
Oh, no. I mean,
So, I mean, you look at their earnings over the next 2 years, I mean, you could have a big problem with earnings falling a little bit here as expenses could go up
and
substantially.
What worries me is that it'll probably be in about 3 years. What happens in 3 years? New presidential election. What if we get a different president? No, that's not good. We want to put stuff overseas. I mean, we've got to. This is a long-term commitment that is being made, and it could change in 3 years because a new president comes in and doesn't agree with it.
Yeah,
So
and
that'd be a shame.
I think the big point I want to try and make here is, while it looks okay, I think there are a lot of potential headwinds for companies in this sector. You got to have, I think, a more attractive valuation before you step in here, because there could be some issues brewing.
I've always wanted to buy Johnson & Johnson, but it's always been too expensive. I thought it'd be a great company, but